Hi, today we are going to introduce you to the Business Valuation Worksheet. By using this worksheet, you will be able to value any business within minutes. The graphic format of this worksheet will allow clarity of thought when assessing values. This worksheet separates the components of a business into tangible and intangible assets. They are not the same and they must be treated differently. The first space on this worksheet is the stock space. The value to be inserted here is today's current value, not what you paid for it. Not what is damaged and not what is missing, and certainly not obsolete or out of date stock. The value we place in this square is all stock that is available for resale at this present time. It is the wholesale price based on what it would cost you to replace today from known suppliers, not what you paid for it many months ago. Now, having said that, it is not in anyone's interest to overstate or understate the stock value. The value we place in this space is based on reasonable guesstimates of actual value, and once inserted, that value can be confirmed by professional valuation at a later date. Now, we will turn our attention to the plant and equipment space. The value to be inserted in this space is the current market value of all plant and equipment held or owned by the owners. Please insert unencumbered values. In other words, any equipment that is subject to loans or hire purchase agreements needs to be ignored at this time. Please do not use written down values in financial statements such as balance sheets or depreciation schedules. They are not relevant and they are accounting and taxation concepts. In other words, they have nothing to do with current markets. Both of these spaces represent tangible assets and are highly definable, and the values attributed to them are provable based on market activity. The next space deals with property assets and generally not included in the sale of a business, except in some geographical locations and circumstances. Therefore, for efficiency's sake, we will bypass this square and you can come back and fill it in at a later date if required. Now, let's tackle the final space, e.g. goodwill valuation. We are now dealing with an intangible asset. This is where turnover methodology is far superior to any other method available in the marketplace. It can keep pace with today's value. How do we find the value of goodwill? Firstly, we use the most reliable figure available in the marketplace, which is turnover. And then we investigate market activity to find the multiplier. Finding the multiplier is the major difference between this methodology and others. Therefore, once the turnover is stated and we now know the multiplier, we simply times the turnover by the rate in the dollar and we now have the final result. We simply add the spaces together for a combined result. We will now tackle the benefits of using this methodology. If turnover has started to move, we can measure it. If turnover is combined, we can separate it. If turnover is spiked, we can adjust. If margins are moving up or down, we can identify them and adjust accordingly. In other words, whatever is happening in this present day, we can allow for projections over the year. We do not have to wait for the end of accounting periods or the preparation of financial statements. Turnover is provable and can be confirmed by source documents such as bank statements. Turnover is reliable and can be profiled and benchmarked, whereas the use of net profits, EBITs or EBITDAs cannot. Now, we are going to give you an example why current methodologies are deficient in their approach to business valuation. Consider the following. Just imagine you are going to buy a business based on the following illustration, and both business A and business B have a net profit of $200,000. Current methodologies simply use some industry average, such as 2 or 2.5 times, and produce a goodwill value of around $500,000. This is a flawed result. It should be obvious that these businesses have different values. If the turnover of business A comes from one source, such as a parent, related party, or is based on specialised knowledge, then the revenue streams may not be transferable, and as such, carry no value. Whereas business B can transfer its revenue streams and is much higher in value. Thank you for watching. We appreciate your time, and you can find us through the links below.